In this edition of Search for Yields from INR Bonds, we talk about bank FDs versus bank AT1 bonds or bank perpetual bonds. I'm Arjun Parsati, INR Bonds, and many advisors and other financial experts talk about the difference in returns an investor can get from investing in bank perpetual bonds or bank AT1 bonds than by investing in their own fixed deposits. Now, I'll take an example of State Bank of India. SBI fixed deposits, as everyone knows, most of you would have SBI fixed deposits or fixed deposits in any bank. And the example of SBI perpetual bonds. So if you take the interest rate offered on SBI fixed deposits, it is around 5.3 to 5.4%, whereas the perpetual bonds are offering over 7%, 7.2 to 7.5%. The latest issuance of SBI perpetual bonds, which is a 5-year call option, is offering around 7.5% in the secondary market. The yield has come down from 7.72%. In terms of credit, in terms of the risk of the issuer, State Bank of India, whether it's the FDs or whether it's the perpetual bonds, it is the same. And in terms of interest rates, obviously the perpetual bonds offer higher interest rate. In terms of maturity, the fixed deposits have a wider time maturity. You can invest from 7 days to even 10 years period in an FD, whereas perpetual bonds, actually they are perpetual bonds, as in the maturity is usually 2099. But the issuer, which is the SBI, has the option to call the bonds, that is, tell the investor that they'll buy back the bonds at a certain date. So the date could be either 4 or 5 years or 10 years from the date of issuance. Now, on the liquidity front, so against fixed deposits, you can either break the fixed deposits or you can either take a loan against that. Whereas in the perpetual bonds, you can send it in the secondary market. And the minimum amount for fixed deposits is obviously very low. But in perpetual bonds, it's the new SEBI regulation says it has to be either 1 crore. And the older bonds come in the face values of minimum investments amounts of rupees 10 lakhs. And on question of investor friendliness, fixed deposits are very, very investor friendly. It's easy to invest. There is no risk involved. You put your money in, you get your money back on maturity. The interest is paid out regularly. But whereas in perpetual bonds or AT1 bonds, it is very investor unfriendly. The structure itself is loaded against the investor. And the reason is that because of the particular nature of the bonds and because of the regulations surrounding these bonds, the bonds are deemed as quasi-equity. They go into capital, additional tier 1 capital, and they have certain clauses that are specified by the regulator. So if the bank has a financial issue and capital adequacy ratio comes down or profitability is negative or low because of bad loans, then the bank may not pay interest. And the RBI might come to tell SBI that since your capital adequacy is low, then you will have to convert these bonds to equity. So there could be many such clauses, which is completely against the investor. And even more important is the SBI has the right to buy the bonds, but not the obligation to buy the bonds on the call date. So if they don't call the bonds for whatever reason, then the bonds go into perpetuity. And when they go into, say, perpetuity, there is a huge amount of interest rate risk, and the pricing is also very low. So secondary market liquidity can be extremely low, and losses can be very high for investors looking to sell in the secondary market. So this is not in any ways to say that SBI will have all these issues, because it is the largest bank in the country, government owned, and is the most important bank for the economy. given their importance in to the economy itself. And they are much safer than any other perpetual bond issuers. But if you take other banks, private sector banks, or even public sector banks that are facing a lot of financial issues, and as we have seen, many public sector banks are getting merged. Government is looking to sell some of them to the private sector and all that. So other public sector banks could have issues. And obviously private sector banks, we all know what happened to S Bank and other after they collapsed. The RBI said that all perpetual bond holders bonds have to be written off, while all the FD holders didn't have any loss because it got taken over by SBI. So very clearly, the trade-off in a bank fixed deposit to the perpetual to the AT1 bonds is the risk of higher interest rates. So if you think you're getting very low interest rates in fixed deposits, and post-tax it is almost nothing, whereas in perpetual bonds the rates are much higher, and many investors are lured to the higher rates and thinking that these bonds, because the same bank bonds are offering higher rates in the market than the fixed deposits, they are advised to invest. But the trade-off here is that they are taking on additional risk, and in FTs they are protected by both deposit guarantee and by the fact that RBI tries to help the depositors when the banks have a problem. But when banks have a problem, RBI says write off the bonds. So all the bondholders lose all their capital. So, and clearly, as I explained earlier, the structure is loaded against the investor, and that's because of the nature of these bonds, nothing else. And the banks are forced to issue such bonds for additional capital, and hence, so from a structure that is FDs are protect the investors and very investor friendly, whereas perpetual bonds are very investor unfriendly, with the issuer having the full option to call or obligation and no obligation to call the bonds at any point of time. And these bonds, if they have any issues, could be, like I said, either no interest could be paid or could be converted to equities or completely written off. So the trade-off is for the higher interest rate, what level of risk you want to take on investing in AT1 bonds. So coming to so INR Bonds QuickInvest has given you a list of all the AT1 bonds on offer. So even SBI AT1 bonds are on offer. But here we definitely educate and guide investors on what are perpetual bonds, what are the risks, and what are we have our own risk rating score. This is apart from what the credit rating agencies give, and also we give you the correct price at which you need to transact. You have the bond details, you have everything, and all you need to do is see the bond. If you like it, you click, and then there's a seamless transaction and execution process, and you get the bonds in your Demat either the same day or the next day. So you can log into INR Bonds, access QuickInvest, and look at all the bonds available. Look at our videos, look at all the research that we have put out. So to come to the conclusion on what bonds, what are the requirements, knowledge requirements you want to learn to invest in fixed income, etc. And don't forget to subscribe to our YouTube channel. Thank you for listening.